Welcome everybody to the latest Keele Business Gateway webinar. In a slight change to the advertised billing, we're joined today by Lewis Stringer from the British Business Bank, and also from BCRS Business Loans, we've got Andy Husritt. Together, we hope to be able to untangle some of the terminology and to help businesses to perhaps better understand the range of support that's available so that you might better identify the right financial support and funding for your business at the right time. Along with Lewis and Andy today, we have Nick Gostick, who's Director of the Smart Innovation Hub here at Keele, plus myself, David Lowe, and I'm one of 3 entrepreneurs in residence at Keele. There are 2 ways for you to get involved today. The first is to submit a question. I think that's to the right-hand side of the screen. And the second, that's in the chat. And the second is to submit an anonymous question via email, which I think is at the bottom of the screen, and enter the question there. Me and Nick will be watching the live chat, and I'll be monitoring the emails, and then we'll be feeding those into discussion at the appropriate times. When we're finished today, the conversation will continue online on Twitter using the hashtag KeeleTalksBusiness, and the same hashtag will be used on LinkedIn. In terms of introductions, I've already been asked on the emails to say a little bit more about what an entrepreneur in residence does. So in brief, there are 3 of us working out of the Smart Innovation Hub at Keele. And we co-develop and co-deliver some of the high-quality programme content for our Innovation Leadership programme. And we do this alongside academics from Keele Business School, plus with our external speakers. And that's where we get to contribute some of our more practical insights and knowledge, which is based on our real-life experience as entrepreneurs and managers of businesses. We also get to coach business leaders on our Innovation Leadership programme, and we do this as part of an intensive one-to-one, typically over a period of about 6 months while people are on our programme. And the aim there is to help people to innovate, to develop, and hopefully to grow their businesses. I'll now ask Nick, Lewis and Andy to introduce themselves and to give a brief overview. So perhaps, Nick, if you could lead off with that.
Hi, I'm Nick Gostick. I'm Director of the Smart Innovation Hub at Keele University. And also, I'm head of the Keele University Science and Innovation Park. So we have about 40 innovation and science-led businesses on site. And also, when we get back in the building, we've got a fantastic hub for early stage innovation-led and growing businesses.
Lewis?
Thank you, David. My name is Lewis Stringer. I'm a Senior Manager at the British Business Bank. The British Business Bank is government's economic development bank. And 7 weeks ago, I was working in what's called the UK Network team, which was very focused on the demand for finance. But for the last 7 weeks, I've been working on some of the initiatives the bank has put together.
Okay. And Andy?
Yes, good afternoon. I'm Andy Husritt from BCRS Business Loans. We're a regional lender based in Wolverhampton. However, I cover Stoke-on-Trent and Staffordshire LEP area, and we lend money to small, medium enterprises in the UK that can't access finance from the traditional sources, i.e. the banks.
Right, lovely. So just to lead off, we've got sort of two key pillars of the government support is the job retention scheme, because that's still supporting cash flow for employees to be retained in businesses. But more significantly, in terms of the finance there, we've got the bounce back loan scheme. And that's to enable smaller businesses to access finance more quickly during the coronavirus outbreak. And that scheme there enables companies to borrow between £2,000 and a maximum of £50,000. Now, the government there is guaranteeing 100% of the loan, and there's nothing to pay for the first 12 months. And then after that, I understand the interest rate is 2.5% a year. So question for Lewis and Andy, what's the risk? Maybe Lewis first.
So I'll kick off. It's all relative, isn't it?
Yeah.
So not just Beebles realising it's the most recent scheme and it's likely to capture quite a few small businesses, but all of the guarantee schemes that we've introduced over the last 7 weeks. I think the one message that I give is, of course, the guarantee that we give is to the lender. It's not to the borrower. And consequently, actually, a borrower is still entering into a loan agreement with a funder, which they remain liable for. And that's the risk for the borrower. And In terms of Beebles, because it is relatively straightforward, I think there's probably a misconception out there amongst the borrowers that actually it's not a loan. I'm sorry it is. And therefore, a borrower needs to enter that realising that at some point they will need to repay that loan.
Thanks. And Andy, is any sort of colour you'd like to add to that?
No, I mean, everything that Lewis has said, really, it is important that from a borrower's point of view that they do understand that this is a loan. The CBILS and the bounce back facilities are both loans, and they are, as a company, liable for that lending in the same way they would be with any loans that they enter into.
And Nick, any thoughts from yourself on that?
Yeah, the question I've got going forward, and appreciate the guarantees for the lender, but in terms of the borrower, the liability falls on the company. But perhaps you could talk us through the personal liability that a business owner manager might actually have from borrowing this money. I understand the business bounce back loan doesn't need any personal guarantees, but there is potential for personal guarantees with CBILS. Is that right?
Yeah, no, absolutely. So the last 7 weeks or so has been a bit of a journey. And in terms of the scheme that the bank has been operating, there have been a number of amendments and changes to those various guarantee schemes. In terms of CBILS, it's effectively an unsecured loan. In terms of Beebles, it's an unsecured loan. In terms of CBILS, when it first started, there was the potential for lenders to take personal guarantees on all lending under CBILS. And one of the bits of feedback we got, particularly from borrowers and entrepreneurs, as you'd expect, is that the thought of a personal guarantee for relatively small amounts of money for a short period of time in the current circumstances was a real issue for them. So one of the immediate things that was done in terms of CBILS, the first guarantee scheme that we introduced, was to remove the requirement for a personal guarantee for lending below £250,000. And then actually it was to, even above £250,000, make it that much easier. So actually, even now, the personal guarantee, if it's taken by a lender for lending above £250,000, is effectively limited to 20% of the default.
Nick, any more on that?
Yeah, perhaps if I could check that at you as well, Andy, and just ask, as actually one of the lenders, what's your view to personal guarantees and the requirements? Are you going to ask for as much as you can in terms of a guarantee?
No, it's been made quite clear to us that for any CBILS lending, we don't take personal guarantees at all. BCRS, although the CBILS originally was up to 250,000, BCRS's maximum is 150,000. We can't go above that level of lending, and we've not taken any personal guarantees for any of our CBILS lending.
And just to clarify there, you're not involved directly in the scheme that we referred to on the outset of this, are you, or are you?
BCRS aren't offering bounce back loans. That's predominantly the high street banks, but we are a CBILS accredited lender through the British Business Bank.
Okay, thank you for that clarification.
That brings forward two interesting things, David. So the first thing is, and Andy's a far more experienced lender than I am, is that in reality, those schemes are effectively tearing up the normal rules around lending, particularly Beebles. So again, to reflect the current circumstances, and Andy isn't one of these, but if you spoke to a grey-haired banker, then actually the thought of doing this type of lending is completely alien to them. Right. And actually, to some degree, although I've got to be careful, there are operational issues at the start of CBILS, and I think those operational issues were as much around people's view of the world and how they historically lent money or how they were brought up as anything else. And again, we have all, including the lenders, had to adapt and change our mindset to reflect the current circumstances. Andy, and I'll spare Andy's blushes, BCRS and the whole responsible finance providers do an excellent job and continue to do an excellent job. But what's also interesting is that Beebles has almost perverted the marketplace a little bit because of the relatively cheap rate and the level of due diligence. It actually probably cuts across existing lending structures. So again, Andy will please correct me, but because ultimately the lenders are still lending their own money, their own capital. Charging an interest rate of 2.5% is great for a borrower, of course it is, but not necessarily great for a lender in terms of lending their capital.
Yeah. So in terms of the job retention scheme that I mentioned, because it is obviously still a source of valid cash flow, and it is supporting people staying in their jobs as opposed to losing them through redundancy, that's now been extended through to the end of October, and people are still going to be receiving 80% of their current salary up to that 2,500. But then we've got this new flexibility being introduced from August, and that's to get employees back to work and to boost the economy as they do so. So as we're reopening, and those furloughed workers, they are returning, perhaps initially on a part-time basis, is that going to be the time and the place for that additional funding outside of the emergency funding? Is that going to be the time and the place where people have got to put cases together to get loans into the companies to take them to the next step? What are your thoughts on that? Maybe Andy first on that.
Yeah, I think that this is a really tricky topic, because from a lender's point of view, and before joining BCRS, I was 20 odd years with Royal Bank of Scotland and NatWest, so I've been in that space as well as this space. It's a difficult one to position, because the emergency funding, if that's what you want to call it, i.e. the bounce back loans, the C-bills, everything else that they can do through the various grants or options that are available, is all very much, for some businesses, that will see them through this period, and it will see them beyond this period, and they will be able to start to trade and trade out of the lull that they've been experiencing. For other businesses, it's a survival mechanism that potentially they are going to need an increased boost in finance when they start to open the doors, because if you think of a manufacturing business, for argument's sake, they're going to need to start buying in raw materials and the labour and everything else that goes alongside that before it's much slower for them to turn the tap back on. So it'll be interesting from where I sit at BCRS to see how the banks react to that, because essentially we've still got businesses that haven't got that financial performance behind them but need that cash flow to go forward. And from BCRS's point of view, we've always done projection-led style lending anyway, and it's about how we get the robust information from those businesses, robust financial information and forecasts, that gives them a fighting chance of being a business that can benefit from additional funding moving forward. So I think in summary, the key is going to be the financial information for whether it's a tier one mainstream bank or whether it's a BCRS type lender. It's got to be on the financial information.
And Lewis, have you got some colour to add to that as well?
Yeah, I guess so. And I'll probably go back a little bit before we go forwards, but Andy raises some great points. So the first thing I'd say is that 7-8 weeks ago, probably over 70% of all businesses either didn't have debt in their business, didn't look to take debt, didn't want to take debt. So actually, almost overnight, through necessity, that mindset within a business has had to change. And I think, again, not only, but part of the operational issues that were faced from the outset was a lack of knowledge about how debt, borrowing worked, how financing worked, actually, to some degree, amongst a vast majority of businesses. So that's the first thing. So the reason I mention that is because, again, I think we're going to have similar but slightly different issues, hopefully, when we do bounce back in terms of the economy. And one of the things I think somebody, and I'm going to guess at some stage it will fall in our direction, that needs to start thinking about is that we're going to have a significant number of businesses that have a significant amount of debt on their balance sheet. And therefore, if they are capable of growing, and it's not just been about survival, how do they fund that? How do we, UK PLC, fund that? So I think one of the interesting things to potentially look at is a potential switch from debt to equity as part of that growth journey, because not all businesses were looking to take equity to grow their business. They didn't like to lose control of their business. So hopefully, if everything rights itself, it's going to be interesting to see how that turns out and goes forward. Because again, as an organisation, we are an equity provider in the same way as a debt provider.
Okay, so where businesses have applied for either C-bills or a bounce back loan, Lewis, perhaps you could, does the business bank have a view as to what they should be spending this money on? and are there any restrictions on what you can't spend it on, and what's the balance between using the funding just survive for working capital, or is there a possibility to actually use some of the money to change their business model, change their products for what might be a new situation post-COVID?
Okay. It's always interesting when we have webinars over the last couple of weeks where the emphasis has changed towards what we're facing and to what we are going to have to do going forwards, which is, I guess, is positive. I'm not sure we're there yet, if I'm being honest. I don't feel like we're there yet, but maybe that's me being pessimistic. But in terms to answer your questions, in terms of Beebles was largely introduced to support businesses at the smaller end of the marketplace very quickly. And consequently, it's been designed and the due diligence has been designed around ensuring that happens rather than not happen. One of the caveats to the criteria is that the Beebles lending cannot be used for personal reasons. We'd expect that anyway. And another relates to refinancing of debts. But other than that, it's pretty open-ended in terms of what it can fund. Okay? The expectation, of course, is that it's used rightly or wrongly to enable businesses to survive over the next X number of months. The reality, if I'm being honest, is a lot of my inquiries are from people not being opportunistic, but seeing it as an opportunity to fund their business in a quick, cheap way, or hopefully growth going forwards. So there are still those businesses out there that are seeing this as a form of finance, rightly or wrongly, to do that growth piece subsequently, either because they're there now or they expect to be there in a month or so's time. Seaballs is a little bit more restrictive. Again, that scheme, more than any other, has been a simple replacement of the existing EFG scheme. So again, part of the operational issues we had were the existing accredited lenders switching from that EFG mindset, which was all about security and collateralization, to more of a, this is about survival mode, mate, guys, and you need to be looking at the viability of the businesses from a historical basis. So that's involved a mindset in terms of the lenders, and most of that lending has been for that very purpose. Does that mean it can't be repositioned, Nick? I don't see why it shouldn't do. The issue that we've got is that it's done under a state aid temporary framework, and that temporary framework reflects the circumstances we find ourselves in. So I think at some stage, if we haven't already, we probably need to go back to the European Commission. Yes, we're still beholden to their rules and regulations to determine whether or not we can use that same vehicle for growth finance in the same way that we have to have those discussions around ERDF funding, which Andy will be aware of. Some of his funds are funded through ERDF and have largely been about growth as opposed to surviving. And there's had to be that discussion, the reverse discussion with the ERDF funding. Right,
yeah. And Andy, you seeing that reflected in the sort of loan applications you're seeing? Is it companies looking to survive, or are you seeing people who are being as a little bit opportunistic and looking to use the funding to fund growth, or even anything else?
Yeah, from my personal perspective and the deals I've been involved in the last 6-7 weeks, it's all been about surviving. It's all been about a lump sum of cash going into the bank account to just get them through after they've done all the other measures with the furloughing and everything else to try and reduce their outgoings as much as possible. It's all been about putting that bit of capital in that will last them for as long as practically possible. I personally haven't seen any other lending requests over this period for anything to do with growth or assets or business acquisition or anything like that.
Okay, so picking up on that point of actually using the money to survive, is there any guidelines on how long businesses should predict or project how long that survival needs to be? Are we expecting that businesses will be able to be up and running October, December, January, and how much do they need to borrow? And if they don't borrow enough, can they come back?
So from BCRS's point of view then, as a lender, in the same way that these businesses don't know how long they're going to be on shutdown for and how long it is before their revenue streams start to come back, From a lender's point of view, we've got no idea about that either. It's a very difficult situation to try and assess, and most or all lending is based, of course, upon risk. So this is a very, very difficult situation for any lender, as Lewis alluded to earlier on. It's a situation what we've not been used to in the past. So from BCRS, we are asking for a cash flow projection. And we're asking that cash flow takes into account the measures that they've taken in terms of furloughing, in terms of any grants available, in terms of any negotiations they've had with landlords, etc., or key suppliers where they've been able to reduce outgoings. And that cash flow for us needs to show that our funding will allow them to survive 3 months beyond when they think they will start trading again, essentially. Now, there's a bit of fluidity in that and a bit of movement in that because, again, nobody knows when that's going to happen. They don't know when they're going to be able to open the doors or when they're going to start trading. So we're taking quite a pragmatic, flexible approach and view of that to say, well, that looks reasonable. And it looks, that business will be able to start gearing back up at such a time. But again, it's a difficult position for a lender.
Okay. Does the British Business Bank have a view on when this has been an impossible question to ask, but do you have a working sort of scenario for when the economy or when businesses will be able to pick up again, and how long that they need to take funding for, Lewis?
Nick, gosh, there's a question. So the answer to that answer is that not that I'm aware of, but that's not to say that cleverer and bigger and more important people than me aren't discussing that as we speak. So let's go back a step again, because I think it's important to do that. So these schemes were set up at speed. They were set up because of the particular circumstances, and there were some initial operational issues, I will not lie. And that was primarily as much around the fact that some businesses, apologies, going to make myself massively unpopular now, panicked, and quite rightly so, panicked. Were unprepared, and consequently, the lenders took a view that actually what you prepared isn't right, and we can't support something with lots of question marks in it, let alone the current circumstances that we face. And there was a little bit of that, and probably a third of those initial inquiries I saw were very much around the borrower not being ready, not being prepared, and not knowing what they need to do in terms of managing costs and managing their cash flow. Bizarrely, that was the realities of life. I guess switching that around a little bit, most of the schemes, there's some variations. Most of the schemes, when they were set up at the start, were set up on the basis that actually it'd be a short-term issue, and actually by 30 September it will be resolved. Okay, so we are still working on that basis, but we've always got an eye to the fact that is that real? We're all living in that same circumstance. Beyond that, it'll be interesting to see the ways in which businesses adapt, change. We still get a regular number of inquiries from businesses that say, but we're being stopped by our lenders about funding a growth proposition. We're in growth mode. We want this funding for growth. And all they're telling to us is that they've got to demonstrate a survival. And we're getting quite a bit of that now. And it has changed, I think, over the last couple of weeks from that initial rush. My concern, and we talked about this at the start, is that actually some of the schemes are driving behaviours and not necessarily positive behaviours. So with Beebles, it's seen rightly, and this is what it's set up to be, a relatively quick, easy means to access finance. And some people have had to access that because they haven't got bank accounts with accredited lenders, etc., etc. But actually, what I don't want to be the case is that disguises a continued lack of planning and preparedness going forwards. Because what I can see is that they've applied for Beebles not necessarily for 100% the right reasons. They will have to look at funding shortly in the short term, and that might create issues for them and us to some degree. Okay, so they've got to be planned and prepared, and that's even more so the case now as it was 6 or 7 weeks ago. Because again, none of us, Nick, know the realities of what's going to happen going forwards. I don't know what's going to happen tomorrow.
And if in fact we've overestimated how long the markets will be closed and companies have borrowed too much money, are there any fees for early repayments? Can they get out of the deals if they don't need the money in that unusual situation?
No.
Okay, so it's good flexibility around that.
Because it serves a purpose, and again, it goes back to your point that it's, there's a degree of throwing the rule book out the window at the moment, and that's the realities of. One thing I touch on a little bit, Nick, if that's okay, is that my life over the last 7 weeks has been accrediting lenders. And what's really interesting, which we've probably not talked about because of probably the audience we've got in place, is actually we're accrediting the business case put forward by the lenders, because outside of High Street, and I can't talk about High Street really to some degree, all of those myriad of alternative funders that are out there that have been accredited, and you'll see from our website, they've got to raise funding. So actually the bigger issue at the moment, and it's still the case, take my word for it, is the difficulty of raising funding for those lenders at the moment. And that's as big an issue as anything else.
Yeah, so is that going to limit these schemes, and is it going to be that the money will run out effectively?
No, because again, what's happening in reality is C-bills, and to some degree B-bills, but less so because of the cost of capital. C-bills is market making. Lenders are coming to us and saying, we've got institutional funders here, but they're only interested if we can get C-bills accredited.
Right. Okay.
So that's the interesting thing from my point of view. As divorced I am from working with borrowers and individual businesses, unlike Andy, actually my life over the last 7 weeks has been bizarrely talking to institutional lenders about the flow of capital into those businesses as opposed to the practicalities of the scheme. That's almost superfluous to it.
Yeah.
How that bounces back, Nick, is the bigger issue for me, and to what degree investors and institutional funders see the norm and therefore the capital flows. There's money there. It's just releasing it.
Yeah. David, did you jump in?
Yeah, to link back to some of the things that both Lewis and Andy have mentioned there in that last few minutes, if I'm a business owner now, and obviously each person's journey is individual and the permutations are unfathomable really, but what should I be looking for right now if my cash flow is still tight, or my cash flow is tight and I'm choosing my options? So should my business be looking for loans, or should it be looking for investment? So, Andy.
Yeah, and I think, that's quite a difficult one to answer really, because it's going to be very specific to an individual business. As Lewis has already mentioned, looking for an investment tends to result in giving up some equity, which some businesses just don't want to get involved in. However, there's a lot of businesses out there that don't like taking debt and have somewhat been forced to take debt over the last 6 or 7 weeks, which is where the ability to repay without the charges is ideal for them, because they want to get it cleared off as quickly as possible because of their they don't like to have that debt in the business. It's going to be different per business as to whether they go down a debt route or an equity investment route. What I would say from a lender's point of view and from a responsible lender's point of view is that you need to explore all the options available to that business and then make a business decision internally as to which route they go. So have they done everything that they can do in terms of furloughing? Have they negotiated as much as they can in reducing their outgoings themselves without any support? Have they got hold of any grants, if they're available for any grants? And there's the LEPs in this country have growth hubs that they can speak to and get information on that, and that's fine. And then really, if it is a choice between debt and equity, that's a business choice really, and whether they get a professional A&I, an accountant or a business advisor to help them with that decision, it's entirely down to them. As a responsible lender, we would always, when I'm writing an application or speaking to a customer about writing an application, I will always ask them, have they been to their bank first? Have they explored all the other options to them before they start entering a contract that they're going to start paying back, immediately with a C-bills loan, although the first 12 months interest is covered by the British Business Bank / government, they've still got to maintain those capital payments. So we tend to have quite an honest conversation with these businesses at the start of any appointment to make sure that they've explored everything they can do.
Yeah. And Lewis, any colour to add to that from your perspective?
I guess just coming back to the question in terms of debt and equity. Equity, certainly at the small level, you get lots of businesses, particularly early stage businesses, and some of those will come out of universities that see equity as the route to go down. And a little bit more open to it, but that's not the case, as Andy alluded to, for a lot of businesses where they see loss of control. I think because we are going to be faced with a large number of businesses with debt in their balance sheet, it's being able to fund that growth piece. Because as Andy quite rightly said, with some exceptions, High Street typically is not looked at funding on a forecast basis, on projections. It's been historical, it's been on balance sheet. And if they're faced with those types of balance sheets, what's their appetite going to be in normal circumstances? So I think there'll be a switch. I hope there's going to be a switch, a mentality between debt and equity a little bit, and seeing equity as a route, rightly or wrongly, realising some of the evils that exist in terms of loss of control. Because equity really is a great growth tool in terms of funding. And it's something the bank's done at an early stage. And again, one thing I need to plug as I'm on the line is that today we've launched our fourth fund, our fourth initiative, and that's the Future Fund.
Yeah.
And again, that is, albeit a convertible loan, is very much on an equity basis. And that's a reflection that actually there are quite a few businesses that were looking to raise equity through no fault of their own at an opportune time. And actually that marketplace from a capital point of view has fallen off a cliff. So that Future Fund's been set up to really just try to leverage the existing private equity that's out there on deals that are very close or were very close pre-COVID to being done. So again, we're already starting to flex that and to look at what the equity route could be going forwards. But again, a second plug, if I may, if you indulge me, is the banks continue to carry on doing the business as usual stuff. So actually, over the last month, we've actually launched the second and third business angel program, for example, and we continue to put money into early stage equity funding. And again, one of the issues, and I'll say this as a Midlander, is that the Midlands does extremely badly in terms of accessing that equity funding. And I think our research, and if Ryan was here, we'd say exactly the same. Our research suggests there's a mentality and mindset there. Anywhere actually outside of London South East in terms of looking at equity as a way of growing their business, that has got to change. And sadly, it may take something like this to change that mindset.
Sorry for the interruption there, Lewis. I think Nick might have something to probe into that in a bit, because we were talking before about the emails that came out from government this morning. But just to refer to what you both said there, is there, and perhaps this is to address a perception, if people are trying to avoid crippling themselves with post-COVID debt, which is a valid concern, it's a hugely valid concern, is there a risk of them ending up with the government as a shareholder? So, Lewis, perhaps if you could address that one.
Yes, yes, is the answer to that. And actually, in normal times, and you can look at our accounts, so it's not a secret, the bank performs very well financially, and it largely performs well financially on the back of the early stage equity investments that it makes on behalf of government, not the debt side, which forms the majority of our business. Because we're investing early, and therefore because we're probably taking a good stake at a reasonable price, and are able to follow that through to some degree to proper future rounds, than actually taxpayer does very well out of that by comparison to debt. The Future Fund has largely been set up to reflect that, the fact that actually in these circumstances with the Future Fund, we don't want to be a shareholder, thank you very much. So actually that's why it's a convertible loan, and if you do a round that we can convert, we'll convert, thank you very much. And we'll, because again, our job would have been done, you'd have been successful, grown, got a further private sector investment, and that's the way the Future Fund's been set up, whereas most of our funds are largely commercial. So do we want to be a shareholder in the funds that come through Future Fund? Yeah, well, we'll see. But are we set out on that basis? No, we're not.
Andy, your perspective on that?
Well, Not really having one. We don't get involved in any of the equity side of things.
No,
we're purely debt provider. Yeah.
I think people are in that place now where they've got to make some decisions that, just a few short weeks ago, you'd never have dreamt of it.
No.
But now, the government support and the pillars of that support are clearly making a difference, but there's still going to be some very hard and right now is some very hard decisions being made. Just to link on to another bit of that previous conversation we were having about sort of loans and post-COVID, how are people going to, because you were saying you don't know what you don't know there, and everybody's sort of in the same boat. So what can people be thinking about now where they're looking to be able to demonstrate that the business is viable post-COVID? What can they be doing when they don't know what that world's going to look like? So have you got any hints and tips that people can be thinking about ahead of when they're going to need to act?
They've got to continue to adapt. So actually, I'm not sure what percentage of the business community this reflects, but I've seen some great examples of businesses adapting, changing markets, changing ways of doing, changing products. And there's a horrible word called innovation, isn't there? I realise I'm in a university environment.
No.
Define innovation, which then takes half an hour as an alumni of a university. Nick knows me well. But actually, yes, I think those businesses that have been able to do that, and let's call it innovation, have actually thrived. And again, there's a Northants business that I've just done some social media on. And without disclosing, they were struggling 6-7 weeks ago, but because they did electronic mail, they're doing exceptionally well. So they've gone from a troublesome portfolio company through no fault of their own to actually flying.
Yeah.
I'm not sure that's going to be right for everybody, though, David. I'm not sure how many businesses that can possibly capture, but you've got to innovate and do things differently.
It's just to get people, because obviously everything is very, very fast moving at the moment. And if you've got some reasonable confidence that you're going to get through to the other side, it really is a matter as a business owner or a business leader to understand what the options are. Even if you're not going to press those specific buttons, it's good to know what your options are so you can make some well-informed choices. So I think perspective is everything there, because the situation will be unique. But yeah, if we can do anything to help people inform good decision making, or as good as it can be, I think that's a great thing. Nick, we were talking before we started today about the Future Fund, because we were reading the communications from the government this morning. So I'm really glad, guys, that we've touched on that. But Nick, do you want to take it forward from there? Have you got any particular...
Yeah, I wanted to pick up on a question that's come up on the discussion feed, and that's about whether the funding is available to startups, and if I can just broaden that question a little bit in terms of what's the minimum requirement in terms of when a business has started, how much financial information they're going to require, because it might be somebody started up a very viable business in November, and then in February it all got shut down. So what's your minimum requirements, both in scale of business and how long they need to be in trading for both the CBILS bounce back and possibly, Lewis, if you could reflect on what those minimum requirements are for the Future Fund. Do you want to start, Andy, on that?
Yeah, I mean, I can certainly talk about the requirements from a credit point of view that BCRS look at. When we're assessing, because of course we need to remember that we're not involved here in the bounce back loans. So from a CBILS loan assessment, we are quite simply saying to a business, you need to prove to us that at the 31st of December 2019, your business was able to support a loan request of what you're asking for now. So if we've got a customer that wants £75,000 now to see them through till September, October time, as long as their business performance via management information, financial information, etc., would have meant they could have borrowed that sum of money in December 2019, then we will proceed to lend, regardless of what's happened post-December 19. So if there's been unpaids on the bank accounts, if there's been time to pay arrangements with HMRC, for argument's sake, we will take a view on those, because we will assume that they are as a result of the COVID-19 effects on their business. In terms of age of business, I don't think there's any sort of hard lines for us. As long as we've got that financial information as at 31st of December, if they can come to us with a balance sheet that shows the business is viable and that there was profits being made enough to service what they're looking for, then we would take a view. If you've got a business that started mid-December and has traded for 2 weeks and's got no financial information, then it would be difficult as a lender for us to make any decision.
Okay. And Lewis, what about the future fund, and is there any minimum requirements on companies accessing equity finance through that?
So let's go back a step then. So apologies, Andy. I don't think BCRS. Are you a startup loan provider, Andy?
No.
Okay. So the bank has something called the Startup Loan Company, which is a scheme that's been running for, crikey, 7 years. And as with most things that the bank does, it works through delivery partners. And the Startup Loans Company is exactly that. It's a loan for a startup business to reflect the fact that even pre-COVID-19, that actually startup businesses would find it difficult to access finance because of track record, accounts, financial information, amongst other things. Okay, that still exists. The latest feedback that I got was that actually demand for startup loans has fallen significantly, i.e., bearing in mind their volume, actually people wanting to start up a business at the moment has fallen. As you'd possibly expect, understand, appreciate, I don't know. Will that change as people unfortunately get made redundant, had a furlough? I don't know. So first and foremost, I would stress the fact that actually that's not going anywhere. In fact, if anything, there's more cash available in Startup Loans Company. It's lent on a personal basis. It's up to 25k per person in a business. It's unsecured. So actually, pre-COVID-19 and B-Balls, it was a really good way of borrowing money for your startup business. They've seen a plummet in demand, partly because of B-Balls, but actually partly because people aren't looking to start up a business at the moment. But it's still there. It's still available, and they can access it very quickly. Okay. In terms of future fund, you missed the point, I think, a little bit if you focus on startup businesses. And I'm going to apologise straight away and say, like B-Balls and C-Balls, it's set up for a purpose. And the purpose is a business may have been looking at a funding round, and COVID-19 has affected the ability of businesses more than ever to raise investment in private sector. Okay. So why do I mention that? I mention that because actually the key criteria for Future Fund is that a business must have raised £250,000 in the previous 5 years from date of announcement. And that's a key criteria, not whether or not it's a startup, not whether or not it's been trading for 2 or 3 years. It's the principle that a business has got to a certain stage and actually is at a stage now where it's looking to do a fundraise and was almost there, fully prepared, but for the fact that COVID-19 has affected the investment marketplace. So when you look at the information on Future Fund, the way it's been designed, and also the way that you access it through the portal, it's done on the basis that you're ready to go. The scheme operates until, gosh, I've got my dates wrong. It's slightly beyond September, end of September. But Nick, more than anybody, will know the length of time it takes to raise investment. Okay, in good times. So actually, it's a vehicle where we're trying to capture as many of those oven-ready deals and trying to leverage what private sector investment exists to get those deals done in those growth businesses. Because coming back to your earlier point, Nick, we are very focused on beyond COVID-19 and supporting those growth businesses at the same time as helping businesses to survive. So the Future Fund is very much that initial growth vehicle to get more growth potential businesses funded. So get away from startup or whatever if they've not raised £250,000 in the last 5 years, or if they've not got at least £125,000 worth of match private sector investment, which is not SIS or EIS, they're not going to meet the criteria in the short term.
Can I just add something on the startup side of things? When Lewis asked if we were a startup loan provider, we're not in the truest sense of the word. However, we will assess a startup loan if they've managed to raise money from Startup Loan Company, for example, and they need a little bit more, but the startups that we would assess would be the ones where they've made some of their own investment themselves. They've got a product and service ready to go. They've got expressions of interest or contracts signed. So the startup for us needs to be a bit further down the road than it would be just, I fancy setting up a business and doing X.
Can we just come in on that as well in terms of companies being primed for growth? Because obviously if they can demonstrate that track record of investment, that's one option, and that sounds like a great option, although the caveat being the time that might take and the effort that might take. But there are, I'm just looking at the chat there are companies that are really, really busy at the moment. They've gone from being actively busy to hugely busy and absolutely sort of revving it. It's not the norm. Absolutely, it's not the norm. But where do they go? Where they know what they're trying to achieve. So, Andy, have you got inquiries that you're actively looking at now where people have got that step up in activity and an opportunity for growth has crystallised in front of them that they feel is sustainable out the other side with their perception of what the new normal might be? Is there a demand there to step up for certain companies?
Yeah, from personal experience, the demand isn't there currently in Stoke-on-Trent and Staffordshire, which is the area I cover. BCRS and myself, for the last 7 weeks, it's all been very focused on CBILS and survivability. However, that being said, if someone approached us today with a genuine request for funding that they can't get through their bank, and we've got the financial information to support it, we will look to lend in the same way we would have done pre-COVID-19. We've not stopped lending in that space. It's just that the demand is coming from CBILS.
So in terms of choices and options, that's a very valid thing to again, for understanding and where they are with risk, that's a very valid option to them to feed into the mix of that decision-making process along the line of time. So that is, they can come to you is the bottom line there, and you would receive that. Yeah.
They certainly can, yeah. But again, in usual BCRS requirements, as they will have needed to have gone to their bank first. Yeah. If they aren't then successful in their bank, that's when we can look to lend. But we will assess a lend on its own merits, whether it's survivability or growth.
I think where I'm coming from there for both yourself, Andy, and Lewis, is that we're not going to potentially, hopefully, not miss out on some real opportunities where companies can step up and can grow and can create jobs. There's a lot of new jobs going to come out the back of this. It's perhaps by no means going to cover all the job losses, given what the Chancellor was saying very, very recently. But it's just that yearning, if you like, to make sure that we don't miss out on opportunities where companies are innovating or companies are expanding, and that the mechanisms are there for them to tap into. So, Lewis, do you want to add to any of that? Is there any?
Yeah, I'll certainly add to that. So again, just coming back to hopefully not being overly pessimistic, is that again, something else we've announced today is that actually there's a fund called the Midlands Engineer Investment Fund, which Andy and BCRS are one of the delivery partners and managers of. So today we've announced effectively our early evaluation of the scheme. We've had to delay it because of current circumstances and the appropriateness of doing that. But it does show that actually, because most of the fund managers and their investments have been around growth deals, that actually there are still opportunities out there. And in fact, BCRS have done a number of deals over the last couple of weeks on that respect, maybe not in Stoke-on-Trent, but elsewhere in the portfolio in terms of growth deals. Actually, our equity fund managers are also still making investments in new deals. And again, they've announced some of the case studies as part of that evaluation today. I think the issue that even the equity fund managers have got is that clearly a lot of their time and effort is being spent on portfolio management. Because again, not all of the existing portfolio companies will benefit from COVID-19, as stupid as that sounds. And therefore, they're investing as much to keep those businesses on a stable footing as anything else. I guess one of the other issues that we've got, and I'll say this, is that clearly most of our accredited lenders have really had to ramp up from an operational point of view in terms of B-bills and C-bills. So actually, they're very heavily focused, as is Andy and the guys at BCRS, on those survive mechanisms and initiatives. And I think there is a danger, through no fault of their own, that actually that means that some of those growth opportunities are missed, or they can't focus on them.
Nick, I'm conscious that you do have quite a lot of interaction with new startups and very young companies, but also with very innovative companies who are on a growth trajectory. Is there anything that you, as we head towards the close in a few minutes' time, is there anything that you'd like to sort of give, again, to give some colour to that and your own experience?
Yeah, I think from a lot of the sort of companies that are in our orbit, I certainly see a range of reactions from companies that have been significantly impacted, and actually significantly impacted from the middle of January. If there were companies that relied on, for example, imports from China of equipment, technology, it's caused quite a few problems for those businesses. But I think one reflection is that people's minds are turning to innovation and are turning to what the post-COVID world might look like, and whether that presents any new opportunities for businesses. I think historically we've often seen the creation of new high growth businesses in the teeth of a recession. Yeah. Certainly I've had the misfortune to set up a company in the middle of a recession, and my view was, if it works in a recession, we'll do great when times get better. But that sort of begs the question: if people take C-bills or bounce back loans, to what extent there is any governance or any requirement to fulfill the business plan they presented to get the loan, and whether there is an opportunity for the business to pivot, and actually say, well, yes, the business was viable in December 2019, but you know what, the market isn't there, customers aren't paying anymore, and actually our business opportunity is somewhere else. Would that be a problem if you've taken bounce back C-bills funding?
So I think the very generic answer to that question is no, Nick. To be brutally honest, is the business plan required for B-bills? It's the first question I'd throw at you. No. In terms of C-bills, yes, probably. Although increasingly we've tried to remove a little bit of bureaucracy, both from a borrower point of view, but also a lender point of view in terms of B-bills. But again, don't forget, you're presenting something that you need to convince, certainly in terms of C-bills, a lender that you can repay that money at some future date. Okay, and the bottom line remains is that you, as a business, that's your hook. You still remain liable for the loan. So if you turn around and say that my marketplace for this product has fallen, you're not going to find a lender that's going to turn around to a borrower and say, well, sorry guys, we only lent you the money on the fact you're producing that product. They don't do that. So again, there's always got to be that adaptability, even pre-COVID-19, in terms of, yes, business plans are written, they're taken as read, but actually, do business plans ever get fulfilled? In reality, bear in mind you're borrowing money, you're often lending over 3, 5, 6, 10 years. Unfortunately, as we found in the last 6 or 7 weeks, things change, don't they?
Yeah. And Andy, how would you feel if you offered a C-bills loan to a company that presented a business plan and financials as to what they were doing in December, but when they come back to you and say either we can't repay you or can we repay on a different pattern or whatever, that the business is actually doing something entirely different because they pivoted to a new market or focused on new products?
Yeah, I think we need to be a bit mindful that's self-employed business outside of a COVID environment anyway.
Yeah.
Every SME that you deal with will adapt and change and offer different products and follow different routes and find different markets because that's just who they are. And that happens in or out of a COVID-19 situation. From a lender's point of view, we lend to that company at the time they make that request. If a lender had got a crystal ball that could see what was going to happen in the future, we wouldn't have any bad loans, would we? Or no. We wouldn't have any need to take any security or anything. So We're not going to penalise a business that's chose to go down a route and something's not been successful, because there's many of us that do that. There's businesses that go down a route and it is successful. It's the nature of business.
It's the dialogue thing that's important, I guess, isn't it, Andy? Whereby there'll be part of BCRS that will just look for the red flags of direct debits being bounced at the month end, whatever. Whereas actually probably your role, Andy, is more like you'd love the business to pick up the phone and say, Andy, I've got this great idea and this is what I'm doing. So it's engagement, and that's never been more important, even though we're all locked down and isolated. It's never been more important to keep that dialogue going with your lender.
Correct. I've always said to every customer I've had, whether it was in the bank or at BCRS, as long as you keep the communication lines open with us and we know what you're doing and what you're up to, then that's half the battle, won. We're prepared for that. And like you say, Lewis, there's always the red flags of unpaid direct debits and all this sort of stuff. And it's how you react and how you communicate beyond that, we'll always try and come to an agreement somehow. It's just what that agreement is and how early you notify us.
Yeah, just one final thought, probably from both of you, because I think we're nearing the end here. Post-COVID world, has either of you got a view from all the businesses that you've been talking to and dealing with? Is it going to be very different, or is it just going to be slightly different? I'm sure it's not going to be the same.
I personally think it's going to be different. I can't see how it won't be different. And I think your businesses that will continue to trade and do very well are probably the businesses that were trading and doing very well and were very mindful of their business beforehand. I think what I would like to see in a post-COVID world, in a selfish sort of point of view, is I would like businesses to realise that they need to get smarter with their financial information. The amount of times we ask for a cash flow forecast or a projection of a P&L and a balance sheet, and that document is produced just to acquire that loan, is scary. These documents should be being used on a daily, weekly, monthly basis by any business, because I dare say, and again, for fear of being hated here, I think if the use of financial information had been more prolific before this, there wouldn't be as many businesses struggling now, I don't think.
I think that does hook into what we were saying before under the heading of what people can start to do now. I think it really does. And Lewis, sorry to sort of interrupt the flow there. What do you have to add to that?
No problem at all. It gave me the opportunity to think, because that was exactly what I was going to say. So I guess from my point of view, if we turn it around to the equity side of things, and again, it's not a great deal of difference. It's called investment readiness. And actually, I'm a great believer in investment readiness. We don't do enough of it, and we don't do it well enough. But actually, when I use that fancy terminology, it's no different from what Andy said in terms of preparing and growth planning. Because actually, investment readiness means that you are testing yourself about the growth potential of your business. And actually, if nothing else, investment raising is very long-winded and is very highly unsuccessful for most businesses. But I tell you what, you learn a lot out of that investment raising process.
Yeah. Okay. I think time is about against us. So my final reflection is, yes, I agree with Andy. Managing the finances tightly in a business is always important, but I also think there is an opportunity now for some businesses to take a little bit of time to think about what that post-COVID world is going to look like. And in a previous webinar, Alan Rogers suggested that we've suddenly leapt forward 5 years in terms of digital adoption, and I think that might change a few things. So, David.
Yes, thanks, Nick. And again, to echo that, and I think if there's one thing that did come into focus for me at the end there is that need to just get the basics right in terms of management information and having a good, robustly populated management information system that you can then use to feed that information into someone who is investing, or if you're applying for grants. It just makes absolute common sense, and I'd agree with you, Lewis. That's exactly what people should be doing. So just final thank yous, really. So thanks from Nick and from me to both our guests today, Lewis Stringer from the British Business Bank and Andy Huswick from BCRS Business Loans. Thanks too to the Hickson Group for hosting the platform, and a big thank you yet again to our audience today for the questions and interactions. We couldn't do this without you, but again, we couldn't get to all of the questions that come in. We do our very best there. But as I said up front, we are going to continue the conversation on Twitter and on LinkedIn, and we're going to use the hashtag Keele Talks Business. Looking forward, we've got one more webinar later this month, and we'll be doing a series of webinars in June, which I'd like to ask you to keep an eye out for, the sort of watch this space, keep an eye out for our promotions with respect to those. The next webinar is actually on the 28th of May, where we'll be looking at the marketing conundrum and how do businesses communicate during and after COVID-19. So in finishing today, I'd like to encourage everyone who hasn't already done so to please sign up to the Keele Business Gateway mailing list. This can be done via the Gateway site, via the email that we will shortly be sending to you. We've also got buttons at the top of the page where you can sign up to the newsletter, and you can link on to the events and the webinar events that we're doing. And finally there, just stay safe, everybody, and take good care. Thanks, everybody. Cheers. Bye-bye.
Bye.
Thank you.